Congratulations on making it this far. You've covered a huge amount. You've learned about the three main financial statements, the key income statement and balance sheet accounts, the core principles of bookkeeping, the double entry principle, the accounting equation, and you know how to work with T accounts and what a debit and credit is. And you've also learned about financial statement analysis, horizontal and vertical analysis, and much more. The next two videos are really the last piece of the puzzle. We'll be looking at ratio analysis. Its key goal is to analyze four main dimensions: liquidity, solvency, profitability, and growth. These are, in fact, the four key topics that need to be addressed when analyzing a given business. Liquidity is the firm's capability to pay its short-term obligations. If we say that a company is liquid, this usually means that a significant portion of its assets are easily convertible in cash. Meanwhile, solvency indicates a company's ability to meet its long-term obligations. If a company finances a high portion of its assets with financial debt, then it runs the risk of having financial difficulties due to increasing interest expenses. Profitability ratios are important for every company, as it has to produce sufficient profits that will satisfy its employees and owners. Given that there can be several drivers that determine whether a company is profitable, it is common practice to break down some of the profitability ratios into smaller ingredients. Growth ratios provide insights about the speed at which a company's revenues, margins, profits, and assets are growing. So, these are the four main dimensions. Let's show a few ratios that are used in order to analyze each of these important dimensions. Some of the most common liquidity indicators are the current ratio and the net trade cycle calculation. The current ratio is given by the fraction between short-term assets and short-term liabilities. It allows us to have an idea about the company's ability to pay its short-term liabilities. The recommended value for this ratio varies according to the industry in which the company operates. However, a ratio above 2 is usually considered good. The net trade cycle shows how many days it takes for a company to convert resources that it uses in the production of its goods into cash. Also known as the cash conversion cycle, this calculation measures the amount of time for which each dollar is tied up in the production and sales process before it is converted into cash through sales to customers. In order to calculate the net trade cycle, we need to calculate DSO, DIO, and DPO. Calculating the net trade cycle is easy once we have DSO, DIO, and DPO. It is given by DSO plus DIO minus DPO. This calculation would allow us to understand whether the firm is efficient in its use of capital. A peer comparison is always helpful in such situations. The main ratios used to evaluate solvency are the debt ratio, also known as leverage, and the interest coverage ratio. The debt ratio shows what portion of a company's assets is financed with debt. In order to calculate it, we need to divide total liabilities into total assets. Of course, the lower this is, the more sustainable the business under consideration. For many industries, a value of up to 0.67 is acceptable. However, you should always compare the ratio with an industry average and avoid applying it mechanically. When a company's debt increases, it has to pay higher interest expenses, right? Financial institutions always want to leave a cushion, which is why they often measure the proportion between a company's operating profits, EBIT, and its interest expenses. If it is higher than 2, then this means that the company will be able to pay its interest expenses and will likely be able to repay some of the principal too. Alternatively, a ratio below 1 shows that a company is unable to repay even its interest expenses and will produce losses for its shareholders. There are many profitability ratios, but we will concentrate on just a few. ROA means return on assets. It is given by EBIT divided by total assets. This is an indicator of the profitability of the company without considering the way in which its activities were financed. ROE, on the other hand, stands for return on equity and is given by net income divided by shareholders' equity. It shows how much profit was generated by a company with the money that shareholders invested in its activities. The ROE ratio can be decomposed. Take a look at the following formula. It shows us that ROE is equal to the following three components. ROA, the ratio that we saw before, multiplied by total assets over owner's equity, multiplied by net income over EBIT. Each of the three components points to a different aspect of the company's structure. ROA is a measure of profitability that does not consider financial structure. Then we have the debt-to-equity ratio, which is an indicator of the company's financial structure, showing the ratio between external and owned financing. And finally, the third ratio incorporates the impact of non-operating items, financial items, taxes, extraordinary items, on the company's profitability. Finally, we have growth ratios. Examples of these ratios are change of sales ratio, growth in total assets, etc. We already saw how to calculate these changes. The calculation of revenues growth can be useful because it helps us understand how fast a company is growing and to compare its growth with its peers. This is one of the crucial aspects that determines how interesting the business is going to be to investors. Okay, wonderful. We learned more about the various types of ratios, and I think that now is the best time for a practical exercise. In our next lesson, we'll calculate each of these ratios for one of the largest companies in the world, P&G.